Hi, I'm Steve Van Metre. Welcome to your Wednesday Night Live, where we take 15 minutes to dissect what's going on in the economy and the markets. And I've got 6 hours of congressional testimony by Fed Chair Jerome Powell for you. Of course, I've netted it down to less than 1 page because, well, if you've ever watched a congressional testimony, it's not the most exciting thing you could do. So let's dive right in, because I think there's some very interesting things from monetary policy. See, why do I watch these things? Because he is going to tell Congress things that he's probably not going to tell other people yet. I mean, all you got to do is watch. So let's take a look. So he first spoke with the Senate yesterday, and the House today. The real beat was within the Senate questions. The House kind of repeated some of them, so there was really nothing new. But they asked him, because you have to understand, the Fed does have a boss. I mean, the president says, I want this person on the board. It's Congress who says you can be on the board. And while they've never removed anyone, it's Congress that has the power to do it. So everyone's beholden to someone. Fed Chair Powell is beholden to Congress. So they asked him about the balance sheet unwind and said, okay, so where are your excess reserves going on this thing? And he said, well, they're probably going down to about $1 trillion, maybe with some padding on top. So I did some math, and that tells us that the Fed should end quantitative easing somewhere around late 2020, early 2021, based on kind of what we know about how much of the $50 billion a month is hitting the excess reserve, which is about $30 billion a month is directly affecting excess reserves. So some quick math, and we have an idea of where this should end. Now, Goldman Sachs reported today that the Fed is going to stop quantitative easing in the third quarter. I don't get it. It doesn't make any sense. It doesn't add up based on, it'd be different if the economy was just totally slumping, because of course the Fed watches the stock market, which they were asked about, and said, well, it's one of our factors. But if we look at what the Fed has been saying over the last couple months and what the speakers have said last week, there's no consistency. It doesn't make sense that the balance sheet unwind would stop that quickly. It might, but there's no evidence that it will. So I'm going to go by the fact that the data says excess reserves are 500 billion or 1.5 trillion and need to drop 500 billion down to roughly $1 trillion, and that puts us late end of next year, early the year after. So anyways, that's kind of what my thoughts are on that side. As far as they asked him about raising rates, the federal funds rate, which I thought was pretty interesting, that, reporters would ask this, and of course he's going to, brush it off. I'm not going to answer. But when it came to Congress, he made it very clear, not once, not twice, multiple times, that the Fed is now in a wait and see approach. And this makes some sense because the Fed says previously that they felt the government shutdown is going to cause some negative data, and which will be filtered out by the second half. So what have we learned is the Fed is probably done hiking rates for the cycle. I mean, we're watching the global economy turn down, but the reality of the situation is they're already telling us there's probably not going to be another rate hike for a while. Well, that won't be till middle of the year. By then, it's going to be too late because there's no more fiscal stimulus. There's no more monetary stimulus. There's nothing. The economy's now got to live on its own. So we'll just say that we've seen the last rate hike for the foreseeable future, at least. There was a lot of questions on farm foreclosures, which I thought was pretty interesting out of the Midwestern senators, saying that they're very concerned that a lot of small farmers are headed into foreclosure. Of course, from a supply standpoint, farmers that aren't growing crops, well, they're certainly not bringing to market. And one of the representatives actually said, from the farmers he talked to, that they're thinking about not planting, because there's no money to be made right now until prices go up. Obviously, it's not the Fed's issue. It's certainly interesting to see. The Fed Chair Powell said the government was on an unsustainable fiscal path. Now, you got to understand the way these testimonies work is you get, congressmen and women on both sides of the party, each wanting to pat themselves on the back for being for or against whatever a sitting president is doing. So, of course, they asked about the fiscal situation, and Powell said it is completely unsustainable. He said our debt to GDP ratio is too high, and as I'm going to add on, this is a big problem during the next recession. I've been saying this. If you understand Keynesian economic theory, which is flawed, it doesn't work, but it's what we got. It's what we're doing. Is in times of expansion. So when the economy is rising, what the Fed should be doing is tightening rates, and the government should be cutting its expenses and building up reserves. We did not do that. In fact, we did the opposite. We've drugged this thing out where we're adding a massive amount of debt. The question is, how are we going to keep adding debt in a recession when Keynesian economics says when you enter a recession, the government needs to deficit spend? I don't know how we're going to do that. And I've been saying one of the reasons this next recession is going to be bad is because we just don't have the policy tools to deal with it that we have in the past. Powell also wanted to say the U.S. economy is strong. So again, the report from Goldman Sachs about the balance sheet unwind ending in third quarter, I mean, maybe it will, but it doesn't make any sense. His concern was slowing global growth, but he felt overall the U.S. economy was very strong. Now, he was asked about modern monetary theory, and I wrote about this in my Facebook post yesterday, so if you have been following me on Facebook, then you'll see that. And modern monetary theory is essentially the direct monetization of debt. So essentially, the government goes out and says, we want to spend all this money, and the Fed says, no problem, here it is. That's what it is. And he got asked about that because you've been hearing things about the Green Deal, or I'm not sure exactly if that's its official name, where there's about $93 trillion that could be spent if such a bill ever got passed, about changing lots of different things to be more eco-friendly. And while that notion may be really good, I haven't dug into it, it would require the Fed to monetize that debt. Of course, when you factor Social Security and Medicare underfunded by, say 100 plus trillion, and you've got state, local, and corporate pensions all underfunded. You've got hundreds of trillions of dollars of potential liabilities here and no way to pay for it. So the idea is the Fed would just step up and say, here's some money, you tell us when you want us to stop and we're done. And he said that's not going to happen. He did not believe that it was up to the Fed to just write a blank check to take care of those things. And that he said the idea that deficits don't matter for countries that can borrow in their own currency is wrong. That is what he's referring to is us. So we borrow in our own currency. And so he's saying deficits do matter. The Fed isn't going to support reckless spending, and the government needs to get its house in order. He went on to say that it was not the Fed's role to provide support for policies, but to achieve maximum employment and stable prices. Now, granted, the Fed has never actually accomplished stable prices, although they think they have. They haven't, and they have no tools to create maximum unemployment. So the fact that they've been or not maximum employment, not unemployment, maximum employment, considering they don't have the tools to do either, it's pretty impressive that Congress has blessed them with such a job. But nevertheless, we're not going to see that. Then in the House, he got a good question on the balance sheet. Of course, as many of you know, the Federal Reserve balance sheet is made up of a big block of U.S. Treasuries and a smaller but still sizable block of mortgage-backed securities or mortgages. And Chair Powell said, look, we want to get rid of these mortgages at some point. We're not sure how, but we want a balance sheet of just U.S. Treasuries. That is our end goal, wherever that's going to be. And they didn't think that the mortgage-backed securities were causing any problems, although they do cause volatility, and Powell knows it because he said it over 5 years ago. Nevertheless, whatever it's going to be, he said they are looking at potential ways to accelerate or get those things off the books. It was interesting that some senators were not big fans of what the Fed was doing. In fact, if you watch this, you'll see in general, Congress isn't overly thrilled with the Fed, unless, of course, they believe the Fed is helping their policies. And in that case, they love them. All right, the content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in the video that I'm own do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. So let's get ready to go look at some charts here. And the notion is the markets make the news doesn't make the markets. And it's interesting that I don't really see much reaction to these testimonies, which maybe means that powers that be already knew about it. So let's just take a walk down here, and we got about 6 minutes left. So let's take a look and see the S&P 500. So I first want to make sure you can see the charts. And here I've got the nice band here showing, well, somehow this moved. I had this all set up, and there we go, and it just moved again because I grabbed the wrong point. There we go. We'll just zoom it out over here, and this is the biggest sell zone that I've ever seen, because it spans all the way back to January of 2018 for the most part. So you can see every time prices have, even gotten a little bit above here, with the exception of this ramp in the middle of last year, this has been a sell zone. Sell, 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 and here we are. It closed. S&P just closed right inside there today, just barely, but very clearly a sell zone. So that's telling us, the big money is selling here. Now, why are they doing that? You have to understand market psychology. Big players will pick some price level that they want to sell at. Maybe they feel that's where people will bid the market up to. And we've seen 6 or 8 of these touches at this level and been rejected. So what this is telling us, this is where the big players want out. Now, when will the market go down? When they're done. Essentially, when they have sold whatever they're trying to get rid of, or as much as they think they can, they'll do it. And then that's when the market will drop. We've seen at least this move here was due to public selling mostly. This is due to computer programs ramping back up. So the next victim is the computerized programs. Let's take a look at volatility. Again, you should never, ever trade this without reading the full prospectus. And if that doesn't scare you, well, good luck to you. Anyways, volatility came down to sitting right at the bottom of the support zone. It came back up after dipping below Monday, and we've been looking at this, at least in the other volatility symbol, that this thing breaks out over this 50 to 52 level, and stock prices are going to crumble. This right here matches back up with right down in here. So we'll see. There will be a retest of these December lows at some point. I thought they'd come a little sooner, but they haven't. But nevertheless, when that gets up there, that's where bad things start to happen. Taking a look at Treasury yields. The short sellers were again forced to defend. Let's look at the 5-year, and you can see in overnight trading, 5 years were breaking below their support, and that forced short sellers to come in, and we can see that they've done this before. When it gets below roughly 2.62, they come as hard as they can. But you notice they had a lot of more strength here, less strength here, and what we're going to expect to see is even less strength here. But not to worry, the banks are buying bonds like crazy, so the big banks know what's coming, and we're still sitting below the 50-day moving average, which is important. Now on the long bond, they just crushed this thing up past the 50-day after we had 2 bullish moves below, or bullish for yields, not bullish for bullish for bonds, bearish for yields. We're looking for yields to collapse. I don't read too much into long bond, and mainly the reason is there just isn't a huge supply compared to the 10-year. So the 10-year is really the benchmark we want. Do we want the long bond to fall? Sure. And will it rapidly move down? Yeah, it absolutely will. All right, so let's quickly look at some other things. I want to look at the gold miners real quick. We saw, I think on last Friday, I went through all the different moving average on the daily, weekly, and monthly, but I don't know why I didn't see this before, but see this gap here. Markets have been very orderly about cleaning up these gaps and filling this in. So I'm expecting prices to come right back down into here. Now, I don't know if it'll get down to 19, but this is definitely giving us a very strong picture of a bullish move in the mining stocks. Silver miners got something similar right here. A gap right at 25.75, so we're watching those. See if we can get down there to start taking some positions, and a low risk move was what I'm hoping for. I thought the oil and gas producers would do a little more today than they did, given the crude inventory build, but they closed up in the green, but you can see they traded down. So I still think we got another double bottom, or at least I think it's going to blow through this. And then I think there'll be a big opportunity in this space as well. That will come later. Looking at the 7 to 10-year Treasury bonds, this is the mirror of the 10-year Treasury yields. You see right here holding above this resistance zone. So the resistance is becoming support, and we can look out and see. I removed all of those because I don't think we're going to need to go back down here anytime soon, but this was resistance, came back up, and now resistance is finding support. The 50-day moving average is rising, so that's good. Looking at the long bond, yeah, it got through the 50-day today, but there's been a lot of support right down under here, and you can see every time it kind of gets up into this resistance level, it gets rejected, and so that just tells you when this finally breaks through, a lot of these people that are short here, again, will get flushed out. as they normally do when these things go the other direction. And what's interesting, though, is we're seeing gold kind of dip. Here's the dollar, as the dollar's giving some weakness. Now, some people are watching the 200-day moving average, looking for this thing to kind of get it down in maybe in this 95 range or right at 95.55, right in here where the 200-day is, and this thing bounce and go. Now, that does not necessarily mean a negative for gold. There are times that both the dollar and gold rally together, so it'll be interesting to kind of see how that goes. All right, so I am out of time for our update, but I will be back with you on Friday for our much longer update. So until then, I'm Steve Van Metre. Bye now.